Understanding capital gains taxes in the United States is more important than ever, especially as we enter 2026. The main difference you need to know is the distinction between short-term and long-term holdings. Short-term capital gains apply to any asset you sell after holding it for 1 year or less. These gains are taxed at the same rate as your regular income brackets. In 2026, these rates can range from 10% up to 39%, depending on your total annual earnings. On the other hand, long-term capital gains apply when you hold an asset for more than 1 year before selling. These rates are significantly more favorable and are typically 0, 15, or 20%. For example, if you are a single filer earning $60,000 and you sell a stock for a $10,000 profit after only 11 months, you will pay your ordinary income tax rate on that gain. However, if you wait just 1 month longer to sell that same stock, you could qualify for a much lower long-term rate. This simple timing difference can save you thousands of dollars in taxes. Always remember to track your purchase dates and consult the tax professional to see how these 2026 rules apply to your specific financial situation. Proper planning is the ultimate key to keeping more of your hard-earned investment returns. Understanding capital gains taxes in the United States is more important than ever, especially as we navigate the financial landscape of 2026. Many investors overlook how much the timing of a sale can impact their bottom line, but the difference between short-term and long-term rates is substantial. To start, you must understand the holding period, which is the amount of time you own the asset before selling it for a profit. If you hold an investment for 1 year or less, any profit you make is considered a short-term capital gain. In 2026, these gains are taxed just like the money you earn from your job, meaning they follow the standard federal income tax brackets. Depending on your total income, this could mean losing nearly 40% of your profit to taxes if you fall into the highest bracket. On the other hand, long-term capital gains apply when you hold an asset for at least 1 year and 1 day. The tax code is designed to reward long-term investing, so these rates are much lower than ordinary income rates. For most taxpayers in 2026, the long-term rate is either 0, 15, or 20%. For example, if you are a single filer with a moderate income, you might pay 0% on your long-term gains, while a short-term sale of the same asset would cost you thousands. Let us look at a practical example to see how this works in real life. Imagine you bought shares of a technology company for $5,000, and those shares are now worth $15,000. If you sell them after only 10 months, your $10,000 profit is added to your regular salary. If your top tax bracket is 24%, you will owe $2,400 in taxes. However, if you simply wait until you have held the shares for 14 months, you would likely qualify for the 15% long-term rate. In this scenario, you would only owe $1,500. By waiting just a few extra months, you effectively save $900. It is also important to consider the net investment income tax, which may apply an additional 3.8% tax if your income exceeds certain thresholds. This applies to both short-term and long-term gains for high earners. Additionally, you should be aware of tax loss harvesting, which allows you to use investment losses to offset your gains. If you have a losing investment, selling it can help reduce the total amount of capital gains tax you owe for the year. As we move through 2026, keeping a close eye on your calendar and your income levels will ensure you keep as much of your investment growth as possible. Always consult with a qualified tax professional to discuss your specific portfolio and filing status, as individual results will vary based on your total financial picture. Investing in the United States markets requires a deep understanding of the current tax code, especially as we look at the specific regulations for the year 2026. The primary factor that determines how much you will owe the government is the duration of your investment, which creates a massive divide between short-term and long-term capital gains. When you decide to sell an asset like a stock, a bond, or a piece of real estate, the Internal Revenue Service looks at exactly how many days you held that asset. Short-term capital gains occur when you sell an investment that you have owned for 1 year or less. These profits do not receive any special treatment, and they are simply added to your other sources of income, such as your salary or business earnings. This means your short-term gains are taxed at your highest marginal tax rate, which for some high earners in 2026 can reach as high as 37 or 39%. In contrast, the long-term capital gains tax system is designed to encourage individual investors to hold their assets for longer periods to support market stability. To qualify for these significantly lower rates, you must hold your investment for more than 1 full year. The tax brackets for long-term gains in 2026 are generally broken down into 3 tiers, which are 0%, 15%, and 20%. For many middle-class families and individuals, the 15% rate is the most common, which is often much lower than their standard income tax bracket. This creates a powerful incentive to be patient with your investments. If you are in a higher income tier, you might also be subject to the net investment income tax, which adds an extra 3.8% on top of your capital gains if your modified adjusted gross income exceeds certain limits. Let us walk through a detailed scenario to illustrate the financial impact of these rules. Suppose you are an investor who purchased $10,000 worth of a popular exchange-traded fund. After 11 months, the value of that fund has grown to $20,000, giving you a total profit of $10,000. If you are a single filer earning $8,000 a year, your marginal tax rate for short-term gains would be 22%. Selling now would result in a tax bill of $2,200. However, if you wait just 1 more month and 1 day, your profit shifts into the long-term category. At your income level, the long-term capital gains rate is likely 15%. In this case, you would only owe $1,500. By simply exercising a small amount of patience, you have saved $700 that stays in your pocket instead of going to the federal government. Furthermore, it is essential to understand the concept of tax loss harvesting during the 2026 tax year. This strategy involves selling investments that have lost value to offset the gains you made on your winning investments. If your total losses exceed your total gains, you can even use up to $3,000 of those losses to reduce your ordinary taxable income. This can be a sophisticated way to manage your overall tax liability while rebalancing your portfolio. You must also stay mindful of the wash sale rule, which prevents you from claiming a loss if you buy the same or a substantially identical security within 30 days before or after the sale. As you plan your financial moves throughout 2026, remember that state taxes can also play a major role. Some states tax capital gains at the same rate as income, while others offer special credits. Managing your portfolio with a focus on tax efficiency is just as important as choosing the right stocks. The difference between a short-term trade and a long-term investment is not just about time. It is about the total return you actually get to keep. Always keep meticulous records of your purchase dates and cost basis, and consider working with a financial advisor to optimize your strategy for the current year.